Top 7 reasons why the IRS will audit you. Hi, I'm Stephen D. Cooper, also known as Coach Coop with Cooper's Accounting Service, because your financial freedom matters. If you like great tax tips, download our popular financial guide at our website, yourfinancialfreedommatters.com, or click below this video. As we get phone calls from various potential clients and even current clients, they want to know what are the new IRS rules, or what are some of the things they can avoid by being audited by the IRS. We're going to cover several topics, but we're going to do 7 for now. Number 1, making a math error. In a math error, it's not a computer error. You may click on the wrong schedule. You got to make sure that if you click on Schedule A, itemized deduction, or income that goes into Schedule C, you wanted to make sure it goes into the correct schedule. That's what can create a math error. Number 2, excessive deductions. What are the excessive deductions? Charitable donations. If you do not have a history of making charitable donations, if you put down $5,000, $10,000, based upon your taxable income, that may be too much. Also, medical expenses. Medical and dental expenses are deductible under Schedule A. Business write-offs. If you only make $200,000 a year, you don't want to put down that you got office expense for $100,000. That just does not make sense. Number 3, self-employment. With Schedule C, you automatically have a 50 to 6% chance of being audited. So you want to make sure that your numbers are reasonable and that they flow. What do I mean by this? As an accounting firm, one of my biggest expenses besides payroll is office supplies. So, meaning if I was a daycare, one of my biggest expenses would be food supplies. Does that make sense when it's a unique business? Number 4, you want to make sure that you are not aggressive in claiming your auto or your home office deduction. You want to be reasonable, fair, and make sure your numbers flow. Number 5, math errors and how to fix them. Once again, your math errors, you don't want to put in too many zeros, which is a human error. Cryptocurrency. You want to make sure that when you are filing your cryptocurrency, that you are filing it similar to a stock trade as a result of this. You typically going to do it on a Schedule D, so you got to do it on the correct schedule first, and you put in when you bought the crypto and when you sold it. If it's less than a year, short term. If it's greater than a year, long term. Number 7, high income earners, which are typically people that make above $400,000 a year. But I want to stress something. People that are worth $250,000, people that make $500,000 or over $1 million a year, all of you are high income earners. But let me explain something a little bit more detail. If you have a simple tax return, W-2, Schedule A, you're good. But if you have businesses, that makes it a little bit more complicated. So if the computer cannot read these tax returns, then a human being from the IRS will need to take your tax returns out and then review them to make sure it makes sense. I like to tell my clients this. When you are a high income earner, you look at your tax returns like a short story. You got to have an introduction, body, as well as conclusion. As we did the recap, you have an idea of what these potential 7 choices that one can make to reduce your risk of being audited. For more easy financial tips, sign up for our newsletter by going to yourfinancialfreedommatters.com or click on the link below this video. You can also download our financial guide as well. If you like a free 20-minute smart money consultation, give us a call at 562-436-2600. Well, again, I'm Stephen D. Cooper, also known as Coach Coop with Cooper's Accounting Service. Do not miss our next video where we will cover what is the purpose of having an NAIC code. See you next video.